future, that's going to shift this short-run aggregate supply curve to the left. If firms expect a lower price level in the future, that would shift the short-run aggregate supply curve to the right. Okay? Changes in the expected price level don't have any impact on the long-run aggregate supply. It's just the short-run aggregate supply. So now, let's just kind of recap what we've done. We talked about the aggregate demand curve. We talked about why it slopes downward. Remember, the key to remembering those explanations is to remember that national income identity. Y equals C plus I plus G plus net exports. So we talked about why it slopes down, and we talked about what causes it to shift around. And all of those explanations had to do with those things. And then we talked about the long-run aggregate supply. What determines the amount of output we can produce in the long run? And that has to do with the amount of real inputs and the technology that we've got. Labor and capital and natural resources, technology. And now we've talked about the short-run aggregate supply. And we've seen that in the short run, firms can make mistakes about the price level. Or it could be that wages are sticky, or it could be that output prices are sticky. And so when the price level changes, firms react to that. They aren't fooled by that in the long run, and they don't make those mistakes in the long run, but in the short run they can. And so we talked about the short run aggregate supply curve and why it slopes upward, and then what causes it to shift. All of these same things as the long run aggregate supply, but now the expected price level is something that's really important. Firms expect a higher price level in the future. That shifts short-run aggregate supply to the left. They expect a lower price level. That shifts it to the right. So now what we can do is we can take these three curves and we can start to use them to understand what happens in an economy when things change. Okay, so we're going to be thinking about two causes of economic fluctuations. Two causes of economic fluctuations. And the two things that we're going to think about are going to be shifts in aggregate demand and shifts in aggregate supply. I'm not going to distinguish right there between short-run and long-run aggregate supply. But what we want to do is we want to think about figuring out what long-run equilibrium looks like in this particular model. So let's think about what we mean by long-run equilibrium. So to be in long-run equilibrium means that we are also in short-run equilibrium. Remember, we talked about the idea behind an equilibrium when we were thinking about the basic demand and supply model. An equilibrium is a situation of rest where things won't change unless something outside of the model changes. So let me show you what long-run equilibrium looks like in this aggregate demand, aggregate supply model. So if we think about, we've got price level up here, real GDP down here. We've got an aggregate demand curve that's downward sloping. It looks like this. We've got a long-run aggregate supply curve that's vertical. It looks like this. Long-run aggregate supply. It is vertical at the natural rate of output. And then we've got a short-run aggregate supply. Now I'm going to draw my short-run aggregate supply curve right up through that intersection of my long-run aggregate supply and my aggregate demand. There's short-run aggregate supply. All three of those are intersecting at the same place. And just like the basic demand and supply model, the intersection of those gives us the equilibrium. So the coordinates of this point tell us the price level, we'll call it P1, and the level of income in the economy, Y1. That's the level of GDP. So let's talk about being in short run and long run equilibrium. Let's start with the short run. Well, if we're interested in what the short run equilibrium looks like, we need to look at the intersection between the aggregate demand curve and the short run aggregate supply curve. And that intersection happens right there. If we want to think about long run equilibrium, then we want to look at the intersection between the aggregate demand curve and the long run aggregate supply curve. And we see that that intersection also takes place right there. So we are in both short run and long run equilibrium. Now, we can be in a short run equilibrium and not be in long run equilibrium. But we cannot be in long run equilibrium without at the same time being in short run equilibrium. What that means is, in the short run, something that can happen to push us to a short run equilibrium, but then over time, we will move to a long run equilibrium. Okay? So it's important that you understand where we start. I'm typically going to label our starting point, point A. We're always, anytime we use this model, we're going to start with a picture of long run equilibrium, and then we're going to shift one of these curves, and we're going to move to a short run equilibrium. And then we'll think about what happens as we move to a long run equilibrium. So what I want to do is clear this off, and then we'll work through a couple of examples of shifts in aggregate demand and shifts in aggregate supply. Let's take a look at what happens when aggregate demand shifts. Now, what I want you to do is, you're taking notes here, is draw another picture of that long run equilibrium so that we can work through it and you don't mess up in your notes what that picture looks like, because you need to know where we start there. So I'm going to draw it again. Let's start with price level, real GDP, aggregate demand. I'm going to put my long run aggregate supply curve and my short run aggregate supply curve right up through there. I'm going to label my initial intersection there point A. I'm going to call my initial price level P1 and my initial level of real GDP Y1. So now let's think about putting a story together here. So we're going to start at A. Price level is equal to P1. Real GDP, I'm going to say Y is equal to Y1. Now remember that real GDP is income. So this is essentially the income of everyone in the economy. Right there. Now, what's not shown on this picture is unemployment and other things, but we'll talk about how those things change when the real level of GDP changes. So we're starting at A. Let's suppose that something happens that causes aggregate demand to decrease. Suppose there's a decrease in aggregate demand. Now let's just review the things that cause that. A decrease in aggregate demand can be caused by people being pessimistic. It can be caused by a terrorist attack. It can be caused by a war. It can be caused by a virus. COVID-19 can cause people to be pessimistic, not go out into the economy and spend money, and especially when the government is forcing people not to go out. They're being prevented from going out and spending money. So that can cause a big decrease in aggregate demand. And so that's exactly part of the explanation for what we've seen with the impact of the lockdown, with the pandemic. So we've got aggregate demand. Let's shift that aggregate demand curve to the left. I'm going to move it from aggregate demand 1 to aggregate demand 2. So we get a decrease in aggregate demand, let's say 2, aggregate demand 2. Now, we need to think first about what happens in the short run, and then we're going to think about what happens in the long run. So let's start with the short run. In order to figure out the place that this economy is going to go in the short run, we need to look at the aggregate demand curve and the short run aggregate supply curve. Right here will be where this economy will go in the short run. I'm going to call that new intersection point B. And the coordinates of that point B are going to give us the new price level, which is going to be P2. It's going to give us the new level of real GDP, which will be Y2. So what we see is we get a new equilibrium at B. The price level falls to P2. And real GDP falls to Y2. So real GDP, incomes, falls to Y2. The economy is in a recession. What we've had is a decrease in the price level. We've had a decrease in incomes. And the bigger that shift in aggregate demand, the bigger the decrease in real GDP. Now, let's think about what's going on behind the scenes. So, less goods and services are being bought and sold. And what that means is that firms are selling less goods and services, which means they need fewer workers. And so, in the background, not shown on this picture, but we know something that happens when real GDP goes down is unemployment goes up. So there's also going to be increases in unemployment while this happens. There's going to be increases in the number of people who can't pay their debts. So banks will start to foreclose on house loans and car loans that people have stopped paying off because maybe they don't have a job to earn money to do it. So other bad things, decreases in profits for firms, increases in foreclosures, as I said. So here at point B, we're in a recession. Now let's think about the long run. So notice that one of the things that's happened is that the price level has gone down. So firms will expect a lower price level in the future. Let's think about all of the different possibilities that could happen here once we're at this recession point, this point B. The first thing is we can think about whether government should do something. So let's ask this question. What should government do? Well, there are a couple of things that the government could do. We talked about the fact that a change in government spending, G, or a change in the money supply will also shift aggregate demand. So one possibility is for the government to increase government spending and shift the aggregate demand curve back where it came from. Now, that clearly won't work in the case of a pandemic where the government does not want people going back out into the economy to spend dollars. And so let's suppose that this was a recession that was caused by, say, a terrorist attack. And people get pessimistic about the future, but there's no reason that those people can't interact out there in restaurants and stores and things like that. In that case, we might say, well, if aggregate demand shifts to the left because of this wave of consumer pessimism that came about because of the terrorist attack, then let's increase G. So one possibility is to increase G and or increase the money supply. Let's write that out. Increase money supply. Both of those things have the effect of shifting aggregate demand to the right. So if the government were to act quickly and decisively, they could theoretically shift the aggregate demand curve back where it came from and move us back from point B to point A. That's a possibility. What we tend to see is that as a practical matter, the government typically can't react quick enough by design. There are checks and balances built into the political system that prevent the government oftentimes from moving rapidly enough to actually achieve what they want to achieve. But there's no reason theoretically that they couldn't think about doing that. And we tend to see these things happen. The government tends to do these things during periods of recession. So that's a possibility. There's a lot of dispute amongst economists as to whether or not the government is actually successful when it tries to do this. But there's another thing that could happen. Even if the government doesn't do anything, let's say, even if the government does nothing, the recession will eventually end. And here's why. Let's say will eventually end. We don't know how long this will take. Here's why. Notice that the price level is below what firms expected. So firms will adjust their expectations about the price level. Now, if you think back a few minutes, you'll remember that one of the things that shifts the short-run aggregate supply curve is firms' expectations about the price level in the future. So if firms expect a lower price level in the future, then that shifts short-run aggregate supply curve to the right. So the price level has fallen. This means that firms expect lower prices in the future. Firms expect lower prices in the future. And let's just say here that remember that the impact of that when they adjust their expectations about the price level is that we're going to have an increase in short-run aggregate supply. When firms expect lower prices in the future, they're going to expect to be able to pay less for inputs in the future. That shifts short-run aggregate supply curve to the right. Remember, that's not going to change the long-run aggregate supply curve, but what happens is, as that short-run aggregate supply curve shifts, as firms adjust their expectations, it's going to shift until we get to a new long-run equilibrium right down here at point C. So we get a rightward shift of the short-run aggregate supply curve from short-run aggregate supply 1 to short-run aggregate supply 2. We get a new long-run equilibrium right back here at point C. Notice that that occurs at a lower price level of P3. And also notice that what's happened is that real incomes have gone down in the short run, but then they went back in the long run as firms adjusted their expectations about the price level. So we go into we start at point A, not in a recession. We move to a recession at point B. Even if we do nothing, eventually what will happen is through firms adjusting their expectations of the price level, we move to a new long-run equilibrium there at point C. Incomes are back where they started. The price level is lower than where it started. So we get a new equilibrium at C. Price falls to P3. Let's say price level falls to P3. Income, or real GDP is back to Y1. It went down to Y2 in the short run, came back to Y1 in the long run. If we were to look at, say, a picture of what the price level looks like in the short run, so let's put time on our horizontal axis. Let's put the price level up here. Price level, this is P. We could also think about what happens to income. So let's put Y up here. This is real GDP or income. Let's write both of those, real GDP, income. Also put time on the horizontal axis. Let's put here P1 and y1. And so when we start out at our initial equilibrium at point A, then what's happening as let's suppose we're just sitting at that long run equilibrium, then if we looked at what the price level looked like over time, it would be sitting there at P1. And our real income would be sitting there at Y1. And then all of a sudden, the aggregate demand curve shifts. Now, remember that the aggregate demand curve shifted here because we thought about a terrorist attack, or maybe it's this pandemic where the government says you can't go out and spend things. Let's go with the terrorist attack, though. What typically happens with a terrorist attack is that people fear that things will be bad in the future. And notice what happens with that. The fear is self-fulfilling. Fearing a recession creates the recession. That's why a lot of economists have very mixed feelings with how the media talks about recessions. The more the media talks about how bad the recession is and how long it's lasted, the more we would expect it to be bad and last longer. So one of the best things to help with that is to try to be optimistic about what the future looks like. I don't know exactly what that means in terms of whether or not you can have public policy around that. I mean, that's very, very challenging. It's hard to be optimistic when things are bad. But the idea here is that pessimism, fear of a bad outcome, at least with an economy like this, will create the bad outcome. So what we saw was that when that aggregate demand curve shifted, we saw the price level fall, and we saw real GDP fall. Not necessarily by the same amounts here. And then we moved to that equilibrium there at point B, and we're sitting at that equilibrium, so maybe the price level kind of levels out and real GDP levels out there for a while. And then over time, either if the government were to shift aggregate demand back to the right, in that case we'd move back to point A and the price level would go back to P1. But in our picture, over time, the short run aggregate supply curve shifted to the right as firms adjusted their expectations about the price level. And what happened was the price level fell even more, and we moved to a new long run equilibrium at point C, and then we're just going to sit there at point C. In terms of incomes, real GDP came back up where it started. And so what we would experience as real GDP goes from Y2 back to Y1 is that unemployment would be going down, profits would be going up, foreclosures would be going down. As people's income returns back to where it started, things get better and incomes go down and then come back up. But in this picture, the price level fell. Typically what we see is that with recessions that are created by a shift in aggregate demand, we tend to see those being deflationary. They tend to drive the price level down. If we think about kind of some historical times when this happened, we could think about the early 1930s. So if we're thinking about the 1930s, what we saw there was real GDP fell. GDP fell by about 27%. Close to a third was the decrease in incomes, real incomes. We also saw unemployment of about 25%. A quarter of the people who wanted to work couldn't find a job. Price level fell by about 22%. And if you think about what happened with the Great Depression, there are lots of different opinions amongst different groups of economists as to exactly what caused the Great Depression, and there's overlap between different groups of economists, but kind of the generally accepted explanation for what happened was that at the end of the 1920s were great, but at the end of the 1920s, the stock market crashed. And what ended up happening was that created this wave of pessimism. And about the same time that happened, there were some runs on banks. There were some banks that started having problems, and what ended up taking place was that even though the Federal Reserve existed at that time, it didn't do its job, and so people started pulling their money out of the banking system, and that we know that when money gets pulled out of the banking system, the money supply is going to fall drastically. And so what happened was the Fed did not try to counteract that. And so at the same time, you've got people feeling very pessimistic about the future, which shifts aggregate demand to the left. You also had huge decreases in the money supply, which also shifts aggregate demand to the left. And so we saw then exactly what this model would predict. We saw declines in real income, we saw increases in unemployment that went along with that, and we saw the price level fall. If we think about the 1940s, let's say the early 1940s, at that point, the Great Depression was over, and the thing that got us out of the Great Depression was the U.S. entering World War II. And what happened when the U.S. entered World War II is that we had to gear up to fight a major war. Government spending increased by a lot, and that shifts aggregate demand to the right. So in the 40s, we had an increase in aggregate demand because of World War II. So we had government spending increase by about fivefold. It nearly doubled real GDP. Nearly doubled real GDP. And think about what that means. It nearly doubled real incomes in the U.S. So when we see an increase in aggregate demand, we would expect the opposite of what's happened here. We would expect an increase in aggregate demand to drive the price level up and drive real GDP up, which we saw. There was also a 20% increase in the price level. And unemployment went from about 17% down to 1%. Lowest it's been in the history of the U.S. So unemployment fell to 1%. There are lots of other minor recessions. Those are really good examples of recessions or expansions that are created by a shift in aggregate demand. One of the challenging things is that with any recession, it's often hard to put your finger on exactly what's happened. So if we were to look at the recession, the U.S. has experienced many recessions. One of the last ones that we experienced prior to 2020 was the 2008-2009 recession. And there are lots of opinions as to what led to that recession. What was it? There were dot-com failures. There were problems in the housing markets. There were a lot of different things that economists kind of debate as to what was the main cause. And that's what makes what has happened in 2020 very interesting, because we know exactly what has happened here, right? The government has prohibited people from interacting economically. The government essentially has put the economy into a deep freeze, hoping that it can thaw it back out. And so it has forcibly prevented transactions between people. Not all transactions, but it's placed a lot of restrictions that prohibit many types of transactions. So the other interesting thing about what's happened in 2020 is that it wasn't just created by a change in aggregate demand, it was also created by a change in aggregate supply, and we'll talk about that next. So I'm going to clear this off, and then we'll think about maybe running through a simple example of this without quite so much detail, and then we'll do a shift in aggregate supply. Let's do another quick example of a change in aggregate demand, but this time let's shift aggregate demand to the right. So if we were to, remember, we're always going to be starting with a picture of long-run equilibrium. So we've got an aggregate demand curve. I'm going to shift it, so I'm going to call that one aggregate demand 1. Price levels up here, real GDP, long-run aggregate supply, short-run aggregate supply. I'm also going to shift short-run aggregate supply, so we'll call that 1. Put our initial equilibrium right here at point A. Here's our initial price level, P1, and our initial level of real GDP, Y1. I'm not going to write out the story for all of this. I'll just talk through it. It might be good to write it down in your notes just to kind of keep track of what's going on as we move through it. Let's suppose that instead of a decrease in aggregate demand, let's suppose there's an increase in aggregate demand. And that could be caused by a stock market boom. It could be caused by the end of a war. It could be caused by entering into a war and aggregate demand increasing because of an increase in government spending. But for whatever reason, let's suppose aggregate demand shifts to the right to aggregate demand curve 2. So we get a rightward shift in aggregate demand. In the short run, we're going to move to a short run equilibrium right here at point B. And the coordinates of that point show us that we're going to have an increase in real GDP to Y2, and we're going to have an increase in the price level to P2. And this economy would be in what we would call an expansion. Now, when we were thinking about a recession, we talked about why the government might have an incentive to step in and try to end that recession. Clearly, there would be no incentive to try to end things when things are going well. So we wouldn't say, well, the government's going to try to, decrease incomes back down. But what will happen is that we know that this recession will end eventually because the price level has gone up and firms are going to expect to have to pay more for inputs in the future. So as firms adjust their expectations of the price level, this short-run aggregate supply curve is going to shift to the left, and it's going to shift to the left enough that we move to a new long-run equilibrium right up here at point C. So here's our new short-run aggregate supply curve. It's shifted to the left. We move to a new long-run equilibrium at point C. That occurs at an even higher price level of P3, and now our real GDP has gone back to Y1. So in the short run, when real GDP is up here at Y2, incomes have gone up, we would observe that unemployment has gone down, profits will have gone up, foreclosures would have gone down. Now income is back where it started, there at Y1, so the expansion is over, and we've got an even higher price level. So typically what we tend to see is that an expansion that's created by an increase in aggregate demand tends to be inflationary. So that gives you an idea. Notice that in what we've done right here and what we did right before this, the long-run aggregate supply curve never shifted because we didn't change technology. We didn't change the amount of inputs that we've got. So our natural rate of output hasn't changed here. And also notice that your long-run equilibrium is always found on that long-run aggregate supply curve. Okay? In the short run, we can move to a place to the right of that aggregate supply curve, long-run aggregate supply curve, or a place to the left. But notice that the short-run aggregate supply curve is, in the long run, going to shift to bring us back onto that long-run aggregate supply curve. So that gives you both a decrease in aggregate demand and an increase in aggregate demand. Let's talk about a shift in aggregate supply. So let's say shift in aggregate supply. Now we could have some event that causes a permanent shift in aggregate supply, meaning that let's say there's a war in your country and a lot of people get killed. then that means there's fewer workers, and in that case, both your long-run aggregate supply and your short-run aggregate supply are going to shift to the left, because now you can produce less output than before. Or we could have temporary decreases in aggregate supply. So let's say a bad weather event. Let's say there's I don't know, unusually high temperatures cause a decrease in agricultural production or something like that. Well, that we would think of as a temporary decrease in aggregate supply. In that case, the long-run aggregate supply won't move, but the short-run aggregate supply curve will. Okay, we're going to think about that type of aggregate supply shift, the type where short-run aggregate supply shifts and long-run aggregate supply does not. And the reason we're going to do that is it's simpler. So let's talk about that. Let's suppose that we draw a picture here where we've got our long-run equilibrium. So we've got aggregate demand, we've got our long-run aggregate supply, and we've got our short-run aggregate supply. Let's call that short-run aggregate supply 1. Let's start with our initial equilibrium right there at point A. Initial price level of P1. Let's label our axes. There's price level, there's real GDP. Here's our initial level of income, real GDP, Y1. So let's do a short story here. We're going to start at A, price level is equal to P1, real GDP is equal to Y1. And now let's suppose that something drives up the cost of production for producers. Maybe it's that the price of oil causes the price of gas to go up. As I said, it could be an adverse weather event. There are a lot of things that can cause temporary disruptions in producers' ability to produce. So let's shift our short-run aggregate supply curve to the left. We get a decrease in short-run aggregate supply to short-run aggregate supply 2. So short-run aggregate supply decreases. Let's say suppose short-run aggregate supply decreases. Let's think about where we move in the short run. In the short run, the impact of this is going to be that our intersection of aggregate demand and short-run aggregate supply is going to be right here at point B. And so we get a higher price level, P2, and we get a lower level of real GDP. We'll call it Y2. So we move to point B. In the short run, we get an increase in price level and a decrease in real GDP. And let's think about what's happening there. So that's a recession. Real GDP has gone down. Notice that this is going to be a particularly painful type of recession. If we were to go back to the first example that I did where we had a decrease in aggregate demand, what we saw was a decrease in aggregate demand sends the economy into a recession, but it drives the price level down. That's kind of like a silver lining. You know, the incomes are going down, but at least the price level has fallen. So everybody's got less money to spend, but at least the prices of goods and services has gone down. If we have a recession that's created by a shift in aggregate supply, then not only do incomes go down, but the prices of everything go up. That's a really painful type of recession, and we've actually got a name for that. We call this stagflation. Very painful type of recession. It's the combination of stagnation and inflation. Stagnation referring to incomes going down, income growth becoming stagnant, and inflation, which is the price level going up. Okay? So any type of recession that's caused by the supply side of the economy, that's caused by a shift in aggregate supply, those are going to be more painful than the recessions that are caused by the demand side of the economy, a change in aggregate demand. So let's think about what the government can do. What can government do? Well, there's not a lot of good options. One possibility is that the government can increase government spending or increase the money supply to shift aggregate demand to the right. And if they did that and it shifted aggregate demand to the right, we would move to a new long-run equilibrium up here at point C. But the problem with that is that causes the price level to go up even more. It causes incomes to go back up, but it causes more inflation. And so you can't offset both of these things at the same time. You can't go back to point A unless you just ride it out. So let's just say an increase in aggregate demand, an increase in aggregate demand would increase real GDP, I'm going to say Y, but also cause inflation. If you think back to one of those basic principles of economics, you'll remember that one of them was that in the short run there's a trade-off between unemployment and inflation. And that's exactly what we're seeing right here. You can't fix both of those. If you want to decrease unemployment, which would happen if you increased real GDP, if you want to decrease unemployment, it comes at a price, and the price is that's going to cause inflation. They could, remember, increase aggregate demand. That should be an increase in aggregate demand by increasing either government spending or the money supply. Okay? The other thing is do nothing. So let's say or do nothing. Eventually, that adverse weather event that caused the decrease in aggregate supply, eventually that will be over, and the economy, as the short-run aggregate supply curve shifted back to the right, the economy would move back to point A. So let's say eventually, whatever caused the decrease in aggregate supply will be over. And then we go back to point A. Here's the problem with that. Politicians are very hesitant to publicly choose this option. And the reason is that people tend to vote them out of office if they're not doing something. That's an unfortunate thing for all of us, because there are many times when it would be better for us all if the government did not do something. Not always, but there are times when that's the case. So the right thing for the government to do might be to not do anything. Because if they do something, it's going to create a different problem, or it's going to be a waste of money. But they face a very strong incentive to be proactive, to try to do things. And so they do tend to do things. And sometimes it creates other problems. Sometimes it causes problems that we've got to become even worse. So if you're wondering, well, why is it that politicians always do something when doing nothing might be the best thing? Well, it's hard to just say, hey, you know what, we're going to do nothing. We know things are bad, but the best thing to do is to do nothing. If everybody had had an economics class and everybody understood the economics of how markets tend to work, then that might be an easier sell, but not everybody understands that. So with stagflation, that tends to be pretty painful. I want to clear this off and then just kind of talk about what has happened with the pandemic, because actually what we've got in this particular case is the combination of a shift in aggregate demand and a shift in aggregate supply, and it's caused things to be especially bad. So let me clear this off, and then we'll finish up with that. This aggregate demand, aggregate supply model is really useful for trying to figure out what's going on in an economy. And most of the time, what we tend to see is that when the economy experiences expansions or recessions, that they're almost always caused by a change in aggregate demand or a change in aggregate supply. It's pretty rare for both of those things to happen at the same time. That's not to say that it doesn't happen, but it's not that common. And what that means is that, you know, it's a lot of times easier to kind of diagnose what's happened, and you know, it may not be easy to figure out exactly why aggregate demand decreased. Sometimes, you know, if you look at the example we talked about earlier, the Great Depression or the recession of 08 and 09, economists debate what they think caused the changes in aggregate demand. What we've had happen in 2020 is, if we think about what's going on here, we've had a change in aggregate demand and a change in aggregate supply, and it was essentially government forced. And so if we think about the price level and real GDP, we've got our aggregate demand curve. Let's put our long-run aggregate supply and our short-run aggregate supply and our initial equilibrium at point A. Now, what has happened is that the long-run aggregate supply curve has not changed. We haven't had a situation where we've lost a lot of natural resources, or where the labor force has shrunk because we've had a war and a lot of people got killed. That has not happened. An overwhelming majority of the deaths that have taken place have been amongst people that are already retired. So the labor force hasn't changed. Our natural rate of output hasn't changed. But what has happened is that the government has essentially forced the closure of a majority of businesses in the economy. And so what happens is, when the government tells you you can't go out and engage in transactions, then people quit spending their money. And so what we've seen is that we've had a decrease in aggregate demand from aggregate demand 1 to aggregate demand 2. That's the first part. But the government also forced the closure of most of the firms in the economy. Well, that means those firms are not producing anything. That's a decrease in short-run aggregate supply. So these firms aren't producing less because of some adverse weather event. They're producing less because the government has told them they can't be open. And so we get a decrease in short-run aggregate supply. Let me draw it over here. So there's short-run aggregate supply 2. What that means is that we need to look at the intersection of our two new curves, and that intersection is going to be somewhere over here. Call it point B. And what that means is we have a relatively large decrease in income. And if we look at what's happened to real GDP, and the picture will become clearer as we're able to get this farther in hindsight, and we're able to actually look at what the data looks like, what we're going to see is that this is going to create a very, very large decrease in real GDP. And it's easy to understand exactly what's going on. This isn't a mystery. We know what happened. The government policy has put us into this situation. And there can be a lot of debate about whether or not the government should have taken those steps. That's certainly available for debate. But we understand exactly where those steps have put us. We also understand fairly easily what's going to happen when those things are removed. So if the government were to remove those restrictions, then the short-run aggregate supply curve would shift back, aggregate demand eventually would shift back, and we'd move back to point A. Now, how long that takes, nobody knows. That is something that is yet to be seen, and it will certainly depend upon whether firms can open, the extent to how much they can sell once they are open. If you make your money selling seats in a theater, and all of a sudden the government tells you that you can only have 30% of the seats that you could before, you're not going to be able to make as much money as you could before. And so you're not going to be able to sell as many seats. And so as the economy starts to reopen and we start to see what restrictions get lifted and what new restrictions might get put into place, we're going to see what type of recovery we have. But the nice thing about this recession is it's easy to understand what put us at point B. Now, where we go from point B, we'll have to see, as I said. So this is a relatively interesting and unusual type of recession. But again, this aggregate demand, aggregate supply model is very useful for thinking about how changes in government spending will affect the economy, how changes in weather events, how terrorist attacks or a virus, how those things might impact the economy. This is a very useful model for understanding what causes recessions, what causes them to happen, what causes them to end. What we'll do in our final section of material that we're going to cover in our next set of videos is that we're going to look specifically at the aggregate demand curve and the impact that changes in the money supply have. So we'll take a look at that in our next video. I'll see you then.